Hello everyone, Clifford Bennett, Chief Economist ACY Securities. I trust you have a very good day ahead of you and the markets might even be kind to you. We saw the long-awaited latest inflation data out of the US, and it did indeed drop toward the expected 4.1%, coming in at 4.0%. Of concern though, and it was good actually, the monthly data on the headline CPI was very flat at just 0.1%. So the bulk of the inflation is clearly behind us. We've halved the extreme inflation rate from the top, but we're still halfway up. And just remember too, the impact on the real economy will be ongoing, because it's not that prices are falling back to where they were before. It's just that they have stopped increasing, or they're still increasing, but they're increasing at half the pace, if you like. So it's still a diabolical economic situation actually on Main Street. And I think market sentiment is a little bit ahead of itself, way ahead of itself, in thinking this means there's no more problems from inflation. Inflation is at extreme levels. This is the headline we're still talking about, and prices are going to stay high. In other words, the pressure on consumers and businesses is going to remain the same, not ease. We'd actually have to see deflation for the pressures of those big price gains on consumers and businesses to ease. So that ongoing burden to the economy is still in place to consumers and businesses alike. Now, of course, the Federal Reserve likes its core PC inflation data, and that actually is remaining very strong. In fact, core inflation is at 5.3%, well above that headline number, because the market, wanting to be bullish, is focusing on the lowest of the two. On the way up there for a while, when core was lagging the headline, people wanted to focus on the core, but now suddenly people don't want to focus on the core, even though they know it is the Fed's preferred measure, ruling out some of the more volatile items of energy and food. So at 5.3%, there's no way the Federal Reserve will be cutting rates. The moderation in inflation at this point in time, I expected stronger numbers actually than what we've just seen. So this will allow the Federal Reserve to stay on hold for a significant period, and then we'll have to see what happens from there with the core inflation rate. But remember, in the background, and now a very dominant part of the Federal Reserve's thinking, is the fact that there is an ongoing banking crisis occurring in the background. And we shouldn't, it's been swept away under the carpet in terms of the financial news media headlines, but it is still taking place out there on Main Street. And speaking of Main Street, not only do we have core PCE inflation data staying very, very strong and very worrying and at crisis levels, they are crisis levels, which means that there is no way, as I said, the Fed can ease. The Fed will be maintaining a tightening bias with a pause at its next meeting. And I still expect no rate cuts this year, which has been my forecast all along. But the small business index also came out on the day, small business optimism index, and it is seriously at crisis levels. And it looks like it's going to head lower. And if there is an indicator that really keeps us in tune with what's going on Main Street in the USA, it is that indicator, and that is still pointing south in a big way. It'll oscillate and bounce around a little bit here, but it's really consolidating at crisis levels with a heavy bias, that sentiment outlook. So lots of tough economic challenges ahead for the United States economy, with borrowing now shooting up, with the debt ceiling having been raised. It's still not a positive outlook for the economy and therefore earnings over the next 12 months. And what was interesting in the price action on the day is that the market was all excited about getting a 4.1 number for the headline inflation, but it actually got an even better number at 4.0. and a better than expected 0.1% for the month-on-month for headline inflation. And even so, the market could have a bit of a rally on the moment of that data being released, but then it spent the rest of the New York trading day at times being heavy, times being bought, but basically it went sideways for the rest of the day. So that is hardly an encouraging to the bulls price action response to this data. What has been a pattern of late is that it is the following day that a lot of the funds get around to buying on any good news. But of course, people are a little bit cautious ahead of the Fed meeting, but the Fed will very likely be on pause, not just because of inflation, but because, as I said, of that ongoing banking crisis in the background. So I think the Fed will be on pause. I think the price action, if people were still needing to buy equities in a big way or keen to, the price action out of that CPI number should have been far more impressive than it was. And so I would think that the market really does need to hold up here. Watch over the next 24 hours. As I said, sometimes there's a one-day delay in the buying on the good CPI news, but there are other factors at force in the United States economy that are still hammering it. And in fact, even though those inflation numbers are still hammering Main Street USA. So I would be very careful about having a simplistic approach to markets that simply because the Fed won't be hiking rates, that's somehow good for the economy. It's not. Therefore, it's not good for earnings. It's about what's really happening, which is Main Street is still in dire straits and inflation is still extremely high, and there will be no rate cuts, even though the US economy is stumbling. And that's the real concern. Have a great day. Clifford Bennett, Chief Economist, ACY Securities.